In today's lecture, we are going to study mergers and acquisitions, why firms pursue them, how synergies create value, and why some deals that look attractive at announcement later disappoint shareholders. A merger or acquisition is one of the most important decisions managers can make. It can change a firm's strategy, risk profile, capital structure, employee base, customer relationships, and future direction. But from a finance perspective, we should not treat an acquisition as a headline, a trophy, or simply a strategic move. We should treat it as an investment decision under uncertainty. The central question is simple. Will the combined firm be worth more than the two firms would be worth separately? That question sounds easy, but answering it requires discipline. A buyer may have a convincing strategic story. The target may be a strong business. The industry may look attractive. But none of that automatically means the acquisition creates value. For value to be created, the deal must improve future cash flows, reduce risk, lower financing costs in a sustainable way, or improve the use of assets. So, throughout this lecture, we will separate three ideas. First, strategic logic. Why might these firms be better together? Second, economic logic. What cash flows, risks, or financing benefits actually change? Third, transaction logic. Who captures the value created by the deal? A good acquisition must pass all three tests. Let's begin with the core test of deal value. In the background, you will see the basic value creation framework. Before the deal, the acquirer has a standalone value, and the target has a standalone value. After the deal, the combined company has a value. If the combined company is worth more than the two companies separately, the deal has created economic value. That extra value is what we usually call synergy. But here's the important point. Gross synergy is not the same as value for the buyer. Managers must move from gross synergy to net synergy. That means subtracting the costs required to complete the transaction and the costs required to integrate the companies. Then, from the acquirer's point of view, we must also consider the premium paid to target shareholders. If the buyer pays more than the target's standalone value, that excess payment transfers part of the expected synergy to the seller. This is why an acquisition can create total economic value and still be unattractive for the buyer. The target may be excellent, the strategic fit may be real, the combined firm may even generate meaningful synergies, but if the buyer pays too much, most of the value may go to the target shareholders rather than the acquirer's shareholders. That is the acquisition discipline. The question is not simply, is this a good company? The better question is this company attractive at this price, under this integration plan, with these risks? Another useful way to think about an acquisition is to treat it as a capital budgeting decision. In a normal capital budgeting project, the firm makes an investment today and expects future cash flows. In an acquisition, the initial investment is the purchase price plus transaction costs. The future benefits include the target's standalone cash flows plus any additional cash flows created because the firms are combined. But acquisitions are more complex than many ordinary projects. The buyer must value an entire organization. It must negotiate under uncertainty. It must estimate synergies before it fully controls the target. And after closing, it must integrate people, systems, customers, brands, contracts, and cultures. This capital budgeting perspective forces managers to ask very practical questions. What cash flows exist only because the deal happens? What investments are required to realize those cash flows? How long will the benefits take to appear? How risky are the expected synergies? How much value will the seller capture through the acquisition premium? And what happens if integration is delayed or only partially successful? These questions prevent a common mistake, treating acquisitions as strategic trophies. A deal is not attractive just because it creates growth, scale, visibility, or excitement. In financial terms, a deal is attractive only when the present value of incremental benefits exceeds the full economic cost of buying and integrating the target. That is why disciplined acquirers think like capital budgeters, not collectors. Now let's discuss the common motives for mergers and acquisitions. Firms may acquire other firms for growth, market power, vertical integration, economies of scale, economies of scope, access to capabilities, geographic expansion, tax benefits, financial benefits, or managerial reasons. Some of these motives can be economically defensible. Others are weak unless they can be translated into incremental free cash flows, risk reduction, or better capital efficiency. This distinction is extremely important. A motive is not the same as a value proposition. For example, growth is a motive, but growth by itself is not proof of value creation. A firm can grow revenue and still destroy value if it pays too much, accepts weak margins, increases risk, or invests in a business that does not earn adequate returns. Market power is also a motive. A combined firm may improve pricing, reduce excess capacity, or strengthen competitive position. But these benefits may be limited by regulation, customer reaction, competitor response, or new entry. Vertical integration may help a firm control inputs, distribution, quality, timing, or supply chain risk. But it can also reduce flexibility and push the firm into activities it does not manage well. Economies of scale and scope can be valuable, but only if managers can identify exactly what will be shared, consolidated, or improved. So the lesson is straightforward. Do not accept an acquisition motive as evidence of value. Translate the motive into cash flows, risks, investment needs, and price discipline. Let's look more closely at growth and competitive position. Growth is one of the most common explanations for acquisitions. A buyer may want more customers, new products, new markets, new distribution channels, or faster expansion than it could achieve internally. This can make sense when organic growth is slow, entry barriers are high, or the target owns assets that would take a long time to build. But growth must be profitable, sustainable, and purchased at a sensible price. A buyer should ask, are we acquiring profitable growth, or are we simply buying sales? Are the target's margins sustainable? Can we retain customers, employees, and distribution relationships? Would internal investment create similar growth at lower cost? Does this deal improve competitive advantage, or does it only increase size? The same discipline applies to market power and competitive position. A deal may create value if the combined firm can reduce excess capacity, improve purchasing terms, strengthen pricing discipline, offer a broader product line, or compete more effectively. But vague language can be dangerous. Phrases like industry leadership, greater scale, or strategic transformation sound impressive, but they do not create value by themselves. A strong competitive position rationale identifies the specific mechanism that will increase cash flows or reduce risk. A weak rationale simply assumes that being bigger is better. In acquisitions, bigger is not always better. Better is better, and better must show up in the economics of the deal. Next, let's examine vertical integration, economies of scale, and economies of scope. Vertical integration occurs when a firm expands into another stage of the value chain. A company may acquire a supplier, distributor, logistics provider, or retailer. The goal is often to control quality, reduce supply risk, protect access to key inputs, improve coordination, or capture margins that another firm previously earned. Vertical integration can create value when market transactions are inefficient. Maybe a supplier has strong bargaining power. Maybe quality is hard to verify. Maybe delays are costly. In those situations, common ownership may reduce contracting problems and improve operational control. But vertical integration can also destroy value. The buyer may lose flexibility. It may enter activities where it lacks expertise. It may become locked into internal supply arrangements that are less efficient than market alternatives. So, managers should ask whether ownership is necessary. Sometimes contracts, partnerships, joint ventures, or long-term supply agreements can achieve similar benefits with less risk. Now consider economies of scale and scope. Scale economies arise when larger volume allows the firm to spread fixed costs, consolidate facilities, reduce duplicate functions, improve purchasing power, or use technology more efficiently. Scope economies arise when the combined firm can share brands, data, technology, distribution, or customer relationships across products. These synergies are strongest when managers identify specific cost pools, assets, systems, or customers. They are weakest when they rely on general claims about scale. And managers must remember diseconomies. Larger firms can become slower, more bureaucratic, and harder to manage. Scale is valuable only when its benefits exceed the cost of complexity. Many acquisitions are also motivated by access. A buyer may want the target's technology, patents, brand, customer base, data, distribution network, management team, regulatory approvals, or geographic footprint. This motive can be powerful when the target owns capabilities that are scarce, difficult to build, expensive to replicate, or uncertain to develop internally. But the key issue is transferability. Some assets are relatively easy to transfer because they are embedded in contracts, software, patents, facilities, or customer accounts. Other assets are fragile because they depend on people, culture, trust, tacit knowledge, or informal routines. This is especially important in capability acquisitions. A buyer should ask, what exactly are we acquiring? Assets, people, contracts, customers, data, reputation, know-how? Can we preserve this capability after closing? Which employees, customers, and partners are essential to the value of the deal? What incentives are needed to retain key people and relationships? Will integration strengthen the capability, or will it disrupt it? A common mistake is to treat a living organization as if it were simply a collection of assets on a spreadsheet. But many capabilities generate value only when people, routines, and relationships continue to function after the transaction. Tax and financial motives also appear in acquisitions. A deal may improve capital allocation, use tax attributes, increase debt capacity, or reduce financing constraints. These benefits can matter, but they should be evaluated conservatively. Financial synergy is credible only when combined ownership makes capital more valuable. Diversification alone is usually a weak justification, especially when shareholders can diversify on their own. Now let's turn to managerial motives, hubris, and empire building. Not every acquisition motive is aligned with shareholder value. Managers may prefer larger firms because size can bring compensation, status, influence, job security, or public attention. Managers may also overestimate their ability to improve the target or underestimate the difficulty of integration. These problems are associated with agency conflicts and hubris. Managerial motives are hard to observe directly, but there are warning signs. The strategic rationale may sound broad, while the cash flow logic remains vague. Management may emphasize size, ranking, or prestige more than returns. The valuation may stretch assumptions to justify a deal that management already wants. The process may become competitive, and management may appear unwilling to walk away. The deal may be justified by accounting metrics without a clear connection to value, or the board may fail to impose a disciplined maximum price. This is why governance matters so much in acquisitions. A buyer can always make a deal look attractive on paper by assuming larger synergies, faster integration, lower risk, or a stronger long-term outlook. But valuation should not be used to defend enthusiasm. It should be used to test it. Good governance requires managers to show not only why a deal could work, but why it creates value under realistic assumptions. A disciplined board asks difficult questions before the deal is signed, not after the problems appear. A useful way to evaluate acquisition logic is to separate strong rationales from weak rationales. A strong acquisition rationale is specific, measurable, and connected to value. A weak rationale is vague, optimistic, and difficult to test. A strong rationale identifies specific cost savings, revenue gains, asset improvements, or risk reductions. A weak rationale simply says the deal is strategic, without explaining the financial mechanism. A strong rationale explains why the buyer is a better owner of the target than the current owners or other potential buyers. A weak rationale assumes that owning an attractive target is automatically valuable. A strong deal model separates standalone value, synergy value, premiums, transaction costs, and integration costs. A weak model blends everything together, making it hard to see who actually captures the value. A strong synergy estimate is tied to operating actions, timelines, responsible managers, and required investments. A weak estimate is presented as a broad assumption. This leads us to the better owner test. The buyer should be able to explain what it can do with the target that others cannot do as effectively. It should explain how those actions increase cash flow or reduce risk. It should identify what investment is required, how much value will be paid away in the premium, and what evidence would cause the buyer to lower its bid or abandon the transaction. This test shifts attention from excitement to evidence, and in M&A, evidence is more valuable than enthusiasm. Finally, let's bring everything together with synergy, value creation, and bid discipline. Operating synergies arise when the combined firm improves operating cash flows. This may come from higher revenues, lower costs, better margins, improved asset utilization, or stronger working capital management. Financial synergies arise when the transaction improves financing capacity, tax efficiency, risk allocation, or capital allocation. Both can create value, but neither should be accepted as a slogan. Each must be translated into expected cash flows, risk adjustments, implementation costs, and timing. Cost synergies are often easier to defend because they are connected to specific actions such as consolidating facilities, eliminating duplicate functions, improving procurement, or combining systems. Revenue synergies can be valuable, but they are often more uncertain. Customers may not respond as expected. Sales teams may resist change. Competitors may react. Additional investment may be required. Managers must also distinguish value creation from value transfer. Value creation means the combined assets generate higher risk-adjusted cash flows than they would separately. Value transfer means one stakeholder gains at another stakeholder's expense. Paying a premium, renegotiating contracts, or changing financing terms may shift value, but that is not the same as creating new economic value. Many acquisitions disappoint because of overpayment, optimistic synergy assumptions, integration disruption, loss of key people, customer reaction, financing strain, or managerial distraction. A disciplined buyer sets a walkaway price before negotiations become emotional. The best acquisition teams are not only good at finding targets, they are also willing to walk away when the price is too high or the risks are too large. Thank you for watching. I hope this lecture helped you understand M&A motives, synergies, and the economics of deal value. I will see you in the next video.